Everybody, James Shepard here with another edition of the Merchant Sales Insight. I want to talk to you about the risk in our business in the payment processing industry. Now, specifically, we're talking about how to sell high-risk merchant accounts, but it's really more of kind of understanding the complexity of risk. And, there's a reason that when we say it's a low-risk merchant account, there's a reason we don't say it's a no-risk merchant account. There is no such thing as a no-risk merchant account. There's high risk, there's medium risk, there's low risk, right? I really enjoyed working on this one with Maverick. I love what they're doing in the high risk, verticals right now. And so this is one of those ones that's going to be very difficult for me to get across in a quick video. I talk really fast, but I don't think I can talk that fast. So this is one of those ones you definitely want to go download. It's kind of a how-to guide of just really understanding how risk works, how underwriting, what are the real risks, when you're dealing with this in our industry. So if you want to check that out, go to ccsalespro.com/insights, and you can download it right there as a PDF. You can also listen to the audio version where I actually read it like an audiobook, but it's significantly longer than the short video is going to be. So it's a really in-depth guide. So let me just dive in. I'm going to just hit the main points, okay? So what we talk about is, in this edition, we talk about three risks, okay? Three kind of underlying risks, and then we talk about three risk multipliers. Okay, so to understand risk, again, not just high risk, just risk in general, the first thing you have to understand is insolvency. When a business goes under, which happens a lot, okay, when a business goes under and or their bank account is drained or blocked or whatever, right? When these kind of catastrophic things happen to a business, that can have really nasty impact on their payment processor, because any remaining risk that's outstanding of people that might file a chargeback or maybe, fines that would be charged by the card brands, any of that sort of thing, it's going to go to the processor that's holding the risk. And if the processor can't pass it on to the business owner, then they're going to have to eat that. Okay. So we have insolvency. That's a huge one. That's really kind of, in my opinion, really at the top of the list as far as the core risk when you're looking at underwriting is, what is the risk that this business is going to go under? And if they go under, what's going to happen? All right, so that's a risk, is insolvency. Another risk would be fines. So is a business doing things in a compliant way, or are they at risk of being fined for something? And so a lot of industries are heavily regulated, and there's actually really specific regulations around even how they accept payments for certain industry types. Well, are these businesses in violation of those? And if so, are they going to get fines from the card brands for the way they're processing? Those fines are going to pass through the processor. So like our sponsor, Maverick Payments, for this edition, they hold all the risk. In fact, they're a FSP, a full service provider. So, they've got everything. They've got all the risk. They've got all the responsibility. So if they underwrite a merchant account and it turns out that merchant is doing things in the wrong way, which will lead us to our third key type of risk, which is fraud. If they allow a fraudulent account to be opened, right? Or if they just see the merchant, they don't catch the fact that the merchant's doing things in a non-compliant way, and then they get a fine from the card brands, and then the business goes under, or they don't have enough money in their bank account, guess who gets stuck holding the bag on that, right? That would be Maverick or whatever the processor is. So that's one of the reasons why it's so important in this underwriting process that the underwriting department understands who they're doing business with. They're able to pull some data and get, a track record on what this is all about. So again, we talk about insolvency, fines, and fraud. Those are the three core kind of elements of risk. But what are the risk multipliers? In other words, those are risks that the underwriting department has to think about for every single business that they underwrite. Whether if they think it's low risk, medium risk, high risk, it doesn't matter. They're going to be thinking about insolvency. They're going to be thinking about fines. They're going to be thinking about fraud and making sure that they have a legitimate account that's in good standing. But then what makes an account high risk? Well, what makes an account high risk is these risk multipliers that I'm going to cover real quickly. And again, definitely download the PDF on this one to get the full version of it. But number one on my list, okay, would be a merchant that has prepaid revenue. So let's imagine we have a travel agency, okay? Travel agency, they accept $1,000, $2,000, $5,000 deposits or payments for trips that are going to happen 3, 6, 9, 12 months from now, okay? So they take these credit card payments. Well, what happens when that travel company goes out of business? And now all these people have prepaid for trips that they're never going to get. Well, hopefully this business was in good standing and they've refunded everybody, but does that normally happen when a business goes out of business or files bankruptcy? No. What usually happens is all those people are screwed. They don't have their trip, but they already put money down. So what do? They turn to their issuing bank and say, hey, I never got this thing I paid for. the issuing bank, that's a chargeback. The issuing bank is going to pass that on, and it's going to go to the acquirer, which is going to go to the processor. And again, in our example for this edition, let's say it goes to Maverick Payments. Well, now Maverick gets, 17, 20, 30, 40 chargebacks for this one travel merchant that went out of business that they were processing for. And lo and behold, when they go to try to get that money from the merchant, well, the merchant's out of business. They shut their bank account down, right? So now, the processor will get stuck with this. So that's one of the reasons why when you look at these high-risk processors, they have to charge a much higher, rate, right? Because when they charge a higher rate, that's offsetting this risk that's inherent with what they're doing. Okay, because they know that's not going to happen every time. That may only happen 1 out of every 100 times. But when it does happen, it's going to cost a lot of money in losses, right? So we have prepaid revenue. Then we have 2 other ones, which are high average ticket size and high monthly volume. I don't have time to get into this too much in detail, but the idea is if a merchant has a really high average ticket size and they get 3, 4, 5 customers to file a chargeback, even though that merchant may not be going out of business, if they don't have enough money in their bank account to cover those chargebacks, then the processor gets stuck with that chargeback loss. And they've got to try to pass it on. Now they're in this nasty collections process, and it's a big mess. Okay, same thing can happen with high revenue. You may have a supplier, a vendor, wholesaler that does, $10 million a month in volume, and they may be operating on razor-thin margins. Well, they can get stuck in a weird situation here where you've got a scenario where, they have people that have paid for something that they're going to ship out, but then the supplier for the wholesaler runs out of the product. They don't have a product to ship, right? At the same time, they miss a loan payment. Their loan gets called in. You can have a nasty scenario happen very quickly with these high volume businesses. And so understand that in those cases, oftentimes with whether it's high volume or high average ticket size, usually much more with the high average ticket size though, you're going to see reserves where the processor is going to want to keep some money back in reserve from the merchant so that they have some cushion for any of these financial losses that might occur. Okay, so we talked about the 3 areas of risk, the 3 risk multipliers. So the question here is, what should we be looking for from a high-risk processor, right? Well, number one, you want a processor that's got expertise. And again, this is why I asked Maverick to work with me on this one. They have to have expertise with the vertical you're working on. Saying that you sell high risk is like a restaurant saying that they sell food, right? Like, is it Mexican food? Is it, Italian? Like, there's a lot of different kinds, right? Same thing with high risk, right? Are you selling CBD merchants, right? Are you going after high average ticket furniture stores? Are you going after e-commerce businesses that have a higher risk profile, but not really seriously high risk? You know what I mean? There's a lot of variables there. So make sure you have a company with expertise in the vertical you're going after. Make sure they have competitive compensation, okay? And by this, I mean, make sure they have different levels of residual split. You don't want somebody that has high risk and low risk, and those are the only 2 options. There's a lot of times where maybe you're selling a vertical in the middle that's not low risk, but it's also not like super high risk. So Maverick has developed a 3-tier residual structure for what they do, and they'll offer different ranges of residual based on the risk profile. So make sure it's competitive compensation, right? Make sure they have infrastructure and like resources, I don't know why, but in high risk, for some reason, we've decided that like most processors in high risk, it's like, you don't really need a good agent dashboard. You don't need, transparent residual reporting. You don't need like a streamlined online application. It's like, actually you need it more than ever with high risk because it's so confusing. You got to deal with all these different sponsor banks, different paperwork. I love what Maverick has done here. They've really streamlined this to say, hey, depending on which one you need to go through, you're fine because, we have maybe all these different sponsor banks, but we know based on the merchant type, Maverick knows ahead of time which application needs to be completed, and their digital process takes you down that path, right? Then at the end of that process, they know what documents you're going to need. Maybe you need bank statements for this one. Maybe you need other things. They're going to list that there. So they've done a really good job, I think, of streamlining that process. Okay, so again, this video was way too short to cover this topic. I really encourage you to go to ccsalespro.com/insights, download the PDF. This would be a good one to just read. The audio version is good, but I really think this is one, even just reading it would be great. So ccsalespro.com/insights. If you want to learn more about Maverick Payments, which again, I love what they're doing with high risk, go to maverickpayments.com. It's Maverick, just like it sounds, payments.com. Reach out to them to learn more. My name is James Shepard. Thank you for watching this edition of the Merchant Sales Insight.